And as our next guest points to historic opportunities right now, investors shifting from fear to greed. Let's bring in Richard Bernstein, CEO of Richard Bernstein Advisors. Richard, it's great to have you. You know, we've been talking about the strike. We've been talking about a potential shutdown. Do you think the bearish arguments are maybe more structural than some of these short-term events?
So Carl, I think it's going to be very difficult to figure out what the extent of the strike or government shutdown is going to be. But you were just talking with Mike 2 seconds ago about long-term interest rates going up and the issue that's having for the stock market. And I think that is, you know, what people aren't thinking about is why are long-term rates going up? And I think the answer to that is the economy is proving to be stronger than people thought. I mean, I personally believe that we shouldn't be talking about a landing, that we should be talking about a takeoff. There's an increasing amount of data that is showing the economy is beginning to re-accelerate. Now, we could argue re-accelerate to what level, but re-accelerating. And if that's the case, then long-term interest rates should be going up. And what you're finding is that some of the more speculative or non-economically sensitive stocks are having trouble with that environment right now. So, you know, I think this is actually more typical than people think. The Fed tends to raise rates when profits are accelerating. Profits are actually looked to accelerating in 2024, to accelerate in 2024. So the notion that the Fed could reverse course or, you know, somehow monetary conditions are going to get easier doesn't make a lot of sense to me.
Yeah, well, your former firm this morning has a piece on what it would take to get the 10-year to 5, and they basically say exactly that. It would take more conviction about reacceleration. They don't really buy it, but you actually see the labor market getting maybe tighter in 24, right?
Yeah, so Carl, I think the amazing thing is we all know that the unemployment rate went up, right? It went from like 3.4 to 3.7. Maybe I'm off on that a little bit, but everybody gets the point. We saw jobless claims ease off a little bit. Okay, that was within the context, that minor cooling of the labor market was within the context of a profits recession in the United States. Profits were down 10 to 15%. If profits are up 10 to 15% in 2024, how in the world does the unemployment rate go up when corporate profits are up 10 or 15%? The odds are that corporate America is hiring people in that environment, which should tighten the labor market, which is why historically one of the reasons when you get profits revving up, the Fed tends to tighten in that environment because the labor market is getting tighter and tighter.
So are you like in Jamie Dimon's camp, 7% rates we should start to think about?
Well, as a former sell-side strategist, earlier in my career, Carl was kind enough to mention my former firm. I don't make pinpoint predictions, but I do think that the way to invest is to say, are rates going to be higher or lower than people think? Right? That's all you have to do. It's kind of an over-under trade. And so I would still be betting that rates are going to be higher than people think, which means multiples will be compressed, which means you can either have your multiple compressed by the P and the PE going down or the E going up. I would prefer the E going up, which brings you to more cyclical sectors.
Here's the thing, though, Richard. There's plenty of evidence that the labor market is starting to cool down. We see it in the number of job openings. I mean, yes, it's still tight and still strong, but we're not seeing the same kind of non-farm payrolls numbers that we were seeing in the prior years. And a lot of people say that's a lagging indicator, and that what we're starting to see is that there's more pressure on the consumer. The excess savings are starting to come down, especially at the lower end. We're seeing the confidence numbers get hit by higher gas prices, still inflation prices. I would suggest there's more evidence for a slowing economy, maybe not a recession, than an accelerating one.
Well, Sarah, you know, you packed a lot into that question, but let me just point out.
I had to take the other side of your argument.
Yeah. No, that's fine. But I think, look, there are leading, coincident, and lagging indicators of labor. One of the leading indicators of labor is weekly initial jobless claims, and they just broke below, meaning they were stronger. They broke below their recent trend. So there you have it. You know, you have that. You've got GDP now, which, again, is not a great forecaster to the decimal point. I get that. But it's pretty good at capturing trends. That's right now close to 5% GDP for the current quarter. You've got an increasing amount of leading indicator type data that is troughing, not troughed, not strong, but troughing. And I think that's what people aren't really like grabbing onto yet. But, you know, one of the things I point out to people is our industry, the financial sector, loves a soft landing. right? It's like nirvana for us. And so I think you have a lot of people hoping that we're going to have a soft landing. I'm not sure the word landing is really right here if these leading indicators continue to turn up. Now, leading indicators, of course, could turn down, but they are leading indicators, and I think that's why it's so important.